Good evening. My name is Dr. Ibikake, and I'm here to present this slide on estate and tax planning as part of the private client module for the LPC, now the SQE. My objectives tonight are as follows. 1. The aim is to provide an overview of estate and tax planning concepts and the importance of managing the financial affairs of clients. Secondly, the aim is to understand clients' financial goals, family dynamics, and unique circumstances to tailor estate and tax planning accordingly. Fourthly, I aim to explain the fundamental principles of taxation in relation to estate planning. And lastly, I will discuss the techniques for tax-efficient wealth transfer, including lifetime gifts, charitable giving, etc. What then is estate planning? The main object of estate planning is to pass wealth onto a beneficiary or your beneficiaries as tax efficiently as possible. These can be a combination of financial planning, lifetime giving of gifts, and giving gifts by will. The aim of estate planning are to achieve financial security together with saving tax. When should tax planning take place? One is during lifetime. And of course, there is the lifetime dealings and the inheritance tax implication. A lifetime dealing can be a chargeable transfer. This is a transfer made by an individual which is not exempt from tax, that is, to a trust or a company. The inheritance tax implications are these: that the tax consequences are that the donor is liable to pay tax at a lifetime rate of 20% or on anything over what is called the nil rate band, currently at £3,000 to £5,000. The nil rate band is the annual threshold, the tax-free threshold. If the donor survives 7 years, then no further tax is payable. But if he dies within 7 years, then taxation is recalculated at 40%. Also, there is the potentially exempt transfer. It's a transfer that is made by an individual to another individual. The inheritance tax consequences are that there are no tax payable at the time a potentially exempt transfer is made. No tax is due if the donor survives 7 years after making the potentially exempt transfer. But if he dies within 7 years, 7-year period, then there will become a potentially chargeable transfer that becomes chargeable. That means the transfer that was initially a potentially exempt transfer becomes chargeable after, if the donor were to die within 7 years of making the transfer. Of course, the principle of cumulation will apply in this case, and that is for a more elaborate lecture. Exemptions and reliefs for lifetime gifts. Now, also a client can take advantage of these exemptions and reliefs for tax purposes. One is the annual exemption, and so there is the annual exemption for an amount, a gift up to £3,000 in any one tax year, and this can be carried forward from previous years. So the point being that a client, an individual, has a tax exemption of £3,000 annually, and this is tax-free. There's also what is called a normal expenditure out of income. A transferor or a donor, a client, can transfer value and that are exempt if he or she can prove that the transfer is made out of normal expenditure and the transferor is left with sufficient income to maintain usual standard of living. Also, gifts in consideration of marriage are also exempt. So gifts made to bride or groom in consideration of marriage are also non-taxable. Family maintenance. Any provision for maintenance for for an ex-spouse or children are also exempt, perhaps due to family separation or family breakdown. Exemptions and reliefs that apply to lifetime gifts on death. Also, there is what is called the spouse exemption. Any gift to a spouse is unlimited and tax-free. Charity exemption. Also, any gift to a charity is unlimited and tax-free. Agricultural property relief. Again, this reduces the value of the property transferred, and the donor must have occupied the property 2 years prior to the transfer, or owned the property for 7 years, while during that time it was occupied by someone during using it for agricultural purposes. Relief may be up to 50 to 100%. Now, also there is what is called the business property relief. Again, this reduces the value of the transfer to property by the transferor of the relevant business by 100 to 50%. Conditions apply in that the transferor must have owned the business for at least 2 years prior to the transfer, and the transferee must still own the business or substitute the business at the date of death. Lifetime dealings and capital gain tax. Capital gain tax liability may arise where a chargeable person makes a disposal of a chargeable asset. A disposal includes both gifts and sales, and chargeable assets include most forms of property, although the pound sterling is not a chargeable asset. Main exemptions and relief for capital gain tax purposes. For example, there is the annual exemption of £6,000 for the current tax year for individuals for the tax year between 2023 to 24. The slide currently has the last tax year. Trustees are only allowed half that amount. Also, there's what is called the wasting assets and chattel. These includes those assets with predictable lifespan of less than 50 years, or chattels disposed of for less than 6,000 years, £6,000. Sorry, all of these are tax-free if they meet the condition and requirements. Main residence exemption. Sales of main residence does not attract capital gain tax liability. If, however, a second home or a holiday home is let, then this will attract a capital gain tax liability. Spouse exemption. Any transfer between spouses results in no gain or loss, and therefore there is no capital gain tax payable at the time of transfer. When the second spouse disposes of the assets, there will, however, be a liability for the total gain from the date of the first spouse acquired the asset to the date of disposal. Lifetime dealings and income tax. So although the main aim of estate planning is to reduce a client's inheritance tax and capital gain tax liability, the income tax position should not be ignored. There are allowances. So if one spouse isn't a tax payer or is a lower rate tax payer, then there should be a consideration whereby the client is advised to take advantage of the personal allowance of the low income spouse. That way, there could be a transfer of the income generating assets to the low income spouse to take advantage of his or her personal allowance. Investments, of course, are also useful in this instance. Um, Clients should consider tax-free investments such as ISAs, PEPs, as we discussed, or certain national savings investments. Tax planning by will, IHT. Many exemptions and reliefs are available on death, such as spouse exemption, charity exemption, business property relief, agricultural property relief. If married or in a civil partnership, couples have the benefits of the transferable nil rate band. The amounts this is amounts the amount of the nil rate band, I beg your pardon, potentially will be based on the proportion of the nil rate band that was unused when the first spouse or civil partner died. Um, the client should consider equalizing the estate. Again, this is for a more elaborate lecture. Now, the advantage of tax planning by will is that there are no capital gain tax payable, as there is a free tax uplift on death. Any gain accumulated prior to date of death, is wiped out. There is need to therefore consider advising the clients, or clients should consider leaving any assets that have risen greatly in value by will to take advantage of this tax loophole. Thank you, and that concludes the end of my lecture and slide.